The dollar just got replaced, not in theory. 6 countries, 6 sovereign nations. In the past several months, they quietly stopped using the US dollar to settle their trade with Canada. No press release, no emergency summit, no cable news chyron, just data. Quiet, undeniable, directional data that tells you everything you need to know about where global finance is heading. And here is the part that should stop you cold. These were not rogue states, not sanctioned economies, not countries with an axe to grind against Washington. These were trading partners making a rational economic decision, one by one, country by country, until the pattern became impossible to ignore. Canada did not just sign some trade deals. Canada walked into a room the United States has controlled since 1944, sat down, and started doing business on its own terms. Washington is watching, and Washington does not like what it sees. This is the collapse wire. We follow the money. We track the shifts that move markets and reshape the global order before they ever reach the front page. If that is what you are here for, subscribe right now and hit the bell. You do not want to miss what is coming. If you are a returning viewer, welcome back. Let us get into it. First, you need to understand what the US dollar actually is, not what it looks like, what it actually is. Because without that, this story is just a footnote. With it, this story is a turning point. The dollar is not a currency. It is a system, the operating system of global trade. That system was locked in during July 1944 at a conference in Bretton Woods, New Hampshire. 44 nations, most of them broke and exhausted from World War II, agreed under heavy American pressure that international commerce would run on US dollars. Oil, grain, metals, shipping contracts, debt instruments, commodity futures. All of it priced in dollars, all of it flowing through American-aligned institutions, all of it subject to whatever Washington decided to do with its monetary policy. That agreement handed the United States something no country in recorded history had ever held: the power to print money and make the rest of the world absorb the bill. Economists gave it a name: the exorbitant privilege. For 80 years it held. The dollar sat at the center of global finance like an anchor bolted to the ocean floor, unmovable, indispensable, permanent, or so everyone thought. Here is what nobody talks about. The cracks did not start with China. They did not start with Russia. They started with the countries nobody was watching: middle-income nations, Southeast Asia, Sub-Saharan Africa, Latin America, countries that were not enemies of the United States, just countries that kept getting hit every time the Federal Reserve made a decision in Washington. The Fed raises rates, their currencies weaken, their dollar-denominated debt gets more expensive, their import costs go up because every commodity is priced in dollars, and dollars just got stronger. They had no vote, no seat at the table, no way to protect themselves. They were passengers on a train they did not own, going wherever the American economy pointed. So they started asking a question that would have sounded absurd 20 years ago. Is there another train? Enter Canada. Now here is what most financial commentators completely missed. Canada was not trying to replace the dollar. That is not how Ottawa thinks. Canada was not running some geopolitical campaign. What Canada was doing was quieter, smarter, and ultimately more effective. Over the past 2 years, Canadian trade officials deepened bilateral agreements with a specific cluster of nations. Nations with natural resources Canada needs. Nations with consumer demand for what Canada produces. And when those deals got settled, the currency question came up. Naturally, almost casually, why route every transaction through US dollars when you can settle directly in Canadian dollars? Why pay the conversion cost? Why expose your trade to Federal Reserve policy decisions when the Fed is not even part of the agreement? The answer was, you do not have to, so they stopped. That is not a political statement, that is arithmetic. And that arithmetic, applied across 6 countries over 2 years, adds up to something that should make every American policymaker uncomfortable. The 6 nations we are about to walk through carry a combined GDP of roughly 1.4 trillion US dollars. That is bigger than the entire economy of Australia. Their combined trade volume with Canada has grown at double-digit rates for 3 consecutive years. When that volume shifts from dollar settlement to Canadian dollar settlement, something structural happens. You create real demand for the Canadian dollar, not speculative demand from a hedge fund making a bet. Actual transactional demand from central banks and trade ministries that now need Canadian dollars on hand to do business. That is a different animal entirely. That is the kind of demand that moves reserve compositions. That is the kind of demand that rewires financial systems. Let us go through the countries one by one. The first country surprised a lot of people inside Ottawa itself, Indonesia, fourth most populous nation on Earth. A rapidly industrializing economy sitting at the intersection of the Pacific and Indian Oceans, one of the most strategically positioned countries in the world, and for the past 5 years, a country quietly and deliberately diversifying its foreign exchange reserves away from a pure dollar concentration. Canada and Indonesia formalized a bilateral trade facilitation agreement in late 2023. Inside that agreement, buried in the technical provisions rather than the headline text, was a specific clause. Agricultural trade, energy trade, mineral trade, all of it now eligible for settlement in Canadian dollars directly using the Bank of Canada and Bank Indonesia as clearing counterparties. No dollar leg, no American bank sitting in the middle taking a cut. Indonesia did not announce it, but the data did. Bank Indonesia's published foreign reserve composition started showing higher Canadian dollar holdings. The US dollar share moved down, slowly, incrementally, but always in the same direction. In central bank reserve management, movement that is slow, consistent, and directional is not noise. It is policy. The second country is Kenya. This one makes complete sense the moment you understand what Canada actually sells to East Africa. Kenya imports Canadian wheat, Canadian lentils, increasingly Canadian agricultural technology, machinery, seed varieties, and irrigation systems bundled with Canadian development financing. Going the other direction, Kenya exports coffee, cut flowers, and finished textile goods into Canadian markets. For years, every leg of that trade ran through the dollar. Kenyan shillings converted to dollars, dollars converted to Canadian dollars converted back. Conversion fees at every step, fees that neither the Kenyan farmer nor the Canadian buyer asked for, fees that went straight to American financial intermediaries for doing nothing except existing in the middle. A significant portion of that trade now settles directly. No conversion, no middleman, no dollar. And here is the number that tells you how deep this shift has gone. Traders in Nairobi are now tracking the Kenyan shilling against the Canadian dollar the same way they used to track the shilling-dollar rate. That is not just a data point. That is a change in financial gravity. When traders change what they watch, it means the underlying flow has already moved. The market caught up to what the central banks already knew. The third country is Vietnam, and from a pure structural standpoint, this is the one that makes the most sense of any on this list. Vietnam is one of the fastest growing economies in Southeast Asia, a major exporter of seafood, electronics, and apparel, a country that has spent 2 decades building its way into the global trading system and looking for partners that offer market access without political conditions attached. Canada is a founding member of CPTPP, the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. The United States is not. Washington walked away from the predecessor agreement in 2017. It has not come back. That single fact created an opening. Hanoi saw it immediately, and Hanoi has been walking through it ever since. When your largest trading partner under a major multilateral framework is Canada, and that partner offers you the ability to settle in a stable G7-backed currency without rooting through Washington, the decision is simple. Vietnam made it. The settlement flow data from both sides confirms it. Now, before we get to the final 3 countries, I need you to step back for a second, because each of these country stories is interesting on its own, but the pattern they form together is something else entirely. What you are watching is the early construction of a parallel settlement layer in global trade, not a replacement for the dollar system, not the death of Bretton Woods, not an overnight collapse, something more like a bypass road. A route that runs alongside the American financial highway, used by countries when the American highway gets too expensive, too slow, too politically complicated. Canada is building that road, one bilateral deal at a time, without press conferences, without threats, without any of the aggressive signaling that tends to trigger an immediate American countermove, just quietly laying asphalt. Now the fourth country. This one is the most underreported of the six and arguably the most significant. Bangladesh, the second largest garment exporter on the planet, a country where roughly 85% of all foreign exchange earnings come from one sector: textiles. Bangladesh built its entire modern export economy on dollar-denominated contracts because American and European retailers demanded it. Dollar invoicing, dollar letters of credit, dollar-priced inputs. The whole machine ran on American currency because Bangladesh had no leverage to say otherwise. Then something changed. Canada became one of Bangladesh's fastest-growing export markets, and Canadian retailers started writing their long-term supply contracts in Canadian dollars. Not as a statement, because that is how Canadian buyers pay. And currency conversion layered into every purchase order adds cost and risk that nobody wants. When those contracts scaled up, the downstream effects were immediate and concrete. Bangladeshi garment factories started maintaining Canadian dollar accounts. Canadian dollar liquidity started moving through Dhaka's banking sector. Banks in Bangladesh started offering Canadian dollar trade finance because their clients were asking for it. And then the move that matters more than any of that, the Central Bank of Bangladesh updated its official reserve management guidelines to formally recognize the Canadian dollar as a reserve currency. Read that again. A central bank updated its reserve policy to include the Canadian dollar. That is not symbolic. That is not a press release. That is a policy decision reviewed by monetary authorities, approved through institutional channels, and reflected in actual reserve allocation. Central banks do not rewrite reserve guidelines by accident. Every word is deliberate. Every change has a reason. The reason here is obvious. The fifth country is Ecuador, and this one is genuinely extraordinary for a reason most people will not immediately see. Ecuador uses the US dollar as its official domestic currency, not a dollar peg. The actual dollar. Bills and coins. Legal tender. Ecuador dollarized in 2000 after a currency collapse wiped out savings across the country. The dollar was the solution. The dollar became the foundation. So when we tell you that Ecuador is now settling certain trade with Canada outside the US dollar system, let that land. A country that literally uses American dollars to buy groceries is finding ways to route commerce around the dollar. That is how significant this shift has become. The driver is oil. Ecuador is a meaningful crude exporter. Its agricultural exports, particularly shrimp and cut flowers, are major Canadian imports. Trade volume between the two countries has been climbing sharply. Canadian negotiators pushed for Canadian dollar-denominated settlement mechanisms in those flows. Ecuador's central bank has not made a full institutional move yet. But Petroecuador, the state oil company, has completed pilot transactions settled in Canadian dollars. A pilot at a state-owned energy company is not a footnote. It is a controlled test before a scale decision. The foot is in the door, and once a foot is in the door, the question is not whether it opens further. The question is, how fast? The sixth country is the United Arab Emirates, and if any entry on this list deserves to be called a genuine shock, this is it. The UAE is one of the most dollar-dependent economies on Earth. Gulf oil has been priced in US dollars since the 1970s. The UAE dirham has been pegged to the dollar for decades. The entire financial identity of the Gulf Cooperation Council is built on dollar alignment. So how does Canada even enter this conversation? 2 words. Critical minerals. The UAE has been running an aggressive diversification campaign, sovereign wealth deployed into supply chains, into manufacturing, into clean energy, into the raw materials the next industrial era will run on: nickel, lithium, cobalt, rare earth elements, the inputs for batteries, electric motors, and advanced electronics that the global economy is going to need in volumes we have never seen before. Canada holds the world's second largest known nickel reserves, significant lithium deposits, cobalt, and beyond the resources themselves, Canada has something equally valuable: mining infrastructure, rule of law, environmental certification systems, geopolitical stability, the things a sovereign wealth fund requires before it writes a check with a 20-year time horizon. When Mubadala, the UAE's sovereign wealth fund, signed investment agreements with Canadian mining companies, a portion included Canadian dollar settlement provisions. Not the majority, not most of it, but enough to register in cross-border capital flow data. Enough to be a documented precedent. Here is why that matters beyond the size of the transaction. The UAE settling anything outside the dollar system, even a pilot, even a fraction of a deal, is a signal. A country whose entire financial architecture was built on dollar alignment just demonstrated that dollar alignment is not a law of nature. It is a choice, and choices can change. That headline did not get written, but the data is sitting right there. Now you should be asking a specific question. If countries want out of the dollar system, why Canada? The euro is backed by a larger economic bloc. The Chinese yuan represents a bigger economy. Why is the Canadian dollar the one getting the call? One concept explains it all. Credibility without conditions. The Canadian dollar is a G7 currency issued by a country with a transparent, genuinely independent central bank. Canada has never defaulted on sovereign debt. Canada's banking system came through the 2008 financial crisis better than almost any other developed nation. Not one major Canadian bank needed a government bailout. The Bank of Canada is not a political instrument. Its decisions are legible. Its framework is consistent. Foreign central banks can model it. And then there is the China comparison, which explains everything. The yuan failed as a dollar alternative not because China lacks scale. China has enormous scale. It failed because Beijing kept attaching conditions to currency access, political alignment requirements, technology transfer expectations, influence operations bundled into the financial relationship. The yuan came with strings. In some cases, those strings looked a lot like chains. Country after country backed away. Canada does not play that game. Ottawa does not demand political loyalty in exchange for trade access. The Canadian dollar does not arrive with a foreign policy agenda stapled to it. From the perspective of a finance ministry in Nairobi or Jakarta or Dhaka, that distinction is enormous. Think about what every major currency on Earth currently represents. The dollar is American foreign policy, the euro is European political integration, the yuan is Chinese geopolitical ambition. Every one of them comes wrapped in someone else's agenda, someone else's conditions, someone else's leverage. The Canadian dollar is clean, and in this environment, clean is not just preferable, clean is rare. Clean is the thing every mid-sized economy has been quietly searching for and not finding. Until now. There is one more dimension to this story, and it may be the most important thing we say in this entire video. Currency arrangements do not just move trade flows, they move infrastructure. The moment a country starts settling trade in Canadian dollars, it needs Canadian dollar instruments to hold those reserves. Canadian government bonds, correspondent banking relationships with Canadian institutions, Canadian capital market access, clearing system integrations. Every single piece of that chain is a root going into the ground, a piece of Canadian financial infrastructure embedded inside another country's economic system. The deeper the roots go, the harder you pull them out. Look at how the dollar became what it is. America did not mandate the dollar's dominance. It built the plumbing. SWIFT, correspondent banking networks, treasury bills as the global safe harbor, the Fed as the implicit backstop. The dollar became impossible to root around, not because it was required, but because every other system was built to connect to it. Removing it meant rebuilding from zero. Canada is not going to replicate that in 5 years, or 10, but the direction is set. And these 6 countries are not the ceiling, they are the floor. There are conversations happening right now in Southeast Asia, West Africa, and South America that Ottawa has not publicized. Canadian trade officials are in those rooms. The currency question is on those tables. More arrangements are in early stages than anyone is publicly acknowledging. What we are watching in real time is a country discovering its own financial gravity. For most of Canada's history, the Canadian dollar existed in the shadow of its American counterpart. A follower currency, a monetary footnote, a system that waited to see what the Fed would do and then reacted. That story is changing, and the 6 countries that chose Canadian dollars over American ones are the proof. Let us talk about Washington, because Washington has noticed. The Federal Reserve tracks global currency flows. The State Department monitors bilateral financial arrangements. The Treasury watches reserve composition data at foreign central banks. Canada's swap arrangements with Indonesia, Kenya, Vietnam, Bangladesh, Ecuador, and the UAE are not hidden. They are in the data. American analysts read the same data we do. The question is not whether Washington is aware. The question is how Washington responds. The United States and Canada are not adversaries. That framing would be wrong. But they are no longer identical partners with identical interests. That era is ending. It is ending because Canada's resource endowment, its minerals, its agriculture, its clean energy capacity became globally strategic in a way that created a real, independent Canadian national interest, an interest that does not always line up with what Washington prefers. That is not a problem. That is what happens when a country grows up. Every serious middle power goes through this transition, from junior partner to independent actor. Canada is going through it now, and it is doing it the Canadian way, quietly, steadily, without the aggressive public posturing that forces an immediate confrontation. The American response will not be loud. Washington does not confront allies openly. It works through institutional pressure. Expect pushback inside G7 frameworks on trade settlement norms, expect subtle friction in defense timelines, expect quiet leverage applied in energy discussions. Washington shapes outcomes the way water shapes stone, slowly, persistently, without announcing what it is doing. Canada's job is to hold both things at once, maintain the alliance, protect the new financial architecture. Do not sacrifice one for the other. That is difficult. But Canada has more leverage right now than it has had in a generation. And leverage is most effective when you know you have it. Now let us make this concrete, because global finance only matters if it eventually shows up in your life. The most direct consequence of growing structural demand for the Canadian dollar is upward pressure on its value. When 6 central banks hold Canadian dollars in their official reserves, that demand is sticky. It is institutional. It does not disappear when a hedge fund changes its position. It persists because it is baked into policy frameworks and multi-year trade contracts. A stronger Canadian dollar means cheaper imports, lower inflation, more purchasing power. For a country that has been watching its dollar weaken, that is a meaningful reversal. When foreign central banks buy Canadian government bonds to hold as reserves, Canadian borrowing costs fall. That is fiscal space, room to invest more in public services or reduce the tax burden on businesses and households. The United States used this exact mechanism to finance deficits for decades. The world needed dollars. The world bought American debt. Canada is beginning to access the same dynamic. For Canadian exporters, the shift is even more direct. A Canadian farmer selling wheat to a Kenyan buyer, getting paid in Canadian dollars, keeps the conversion cost inside the Canadian economy. That fee used to go straight to an American financial intermediary, not because the intermediary added value, because the dollar was the mandatory transit point. Now it is not. Across the full volume of Canadian exports to these 6 countries, that redirection represents billions of dollars per year flowing back to Canadian producers, Canadian banks, and the Canadian economy. Not a rounding error, real money. But here is the thing, this is an opening, not a guarantee. The window Canada is sitting in right now, clean currency, no political strings, critical resource endowment, G7 credibility, will not stay open forever. Other currencies are watching, other systems are competing. If Canada does not move with intent and urgency to lock this in, someone else fills the space. That is how these windows work. They open, they close. You either walked through or you did not. 3 things have to happen. First, Ottawa needs to formalize. Pilot programs and informal arrangements are how things begin, but they are not how things last. What exists right now needs architecture. Formal currency swap lines, investment treaty language that protects Canadian dollar settlement mechanisms, Canadian financial institutions properly resourced to service the global demand that is building. The foundation is poured. The structure needs to go up. Second, Canada needs to fund its financial diplomacy. The United States has an enormous machine maintaining dollar primacy, treasury, state, commerce, the Fed, all coordinating. Canada's equivalent is a fraction of that capacity. If Ottawa is serious about what the data is showing, it needs to invest in the people and institutions that turn bilateral deals into a permanent global network. Third, Canada needs to own this story, not with arrogance, not with the kind of chest thumping that forces Washington into a corner, but with clarity, with confidence. Canada has spent too long defining its economic identity as the quieter version of its southern neighbor. That framework is not just outdated. Right now, in 2026, it is simply wrong. This is a Canadian story. It belongs in Canadian classrooms, in Canadian boardrooms, in the conversations Canadian voters have about what their country is and what it is becoming. This is the collapse wire. The shifts that actually matter, the ones that determine where money flows and who holds power 10 years from now, they do not make headlines when they happen. They get buried in reserve composition tables and bilateral trade footnotes. We dig them out. We bring them to you. If this video changed how you see Canada's place in the global financial order, drop a comment. Tell us which of the 6 countries hit hardest. Tell us what Canada should do next. Share this with someone who still thinks the dollar is untouchable. Because now you know, the cracks are already there. Subscribe if you are not already here. We will see you in the next one.